Hey everyone, Verizon reported quarterly earnings results yesterday, and the company now has a dividend yield of over 6.6%. So investors are now even more curious about Verizon stock, asking if it's safe, if the dividend yield is safe, and if they can count on this dividend longer term. So what I'll do here is I'll review Verizon's latest quarterly earnings results from the perspective of a dividend stock investor looking to generate passive income from Verizon communication stock. So let's jump right into it.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so I mentioned the company's dividend yield is now over 6.6%, 6.64 to be precise. It's a robust dividend yield compared to what investors can get from government bonds. It's a little bit better. Government bond right now, if you're looking at a 30-year government bond, it's less than 5%, close to 4.6%. If you're looking for a shorter-term government bond, those can be had for over 5%. You can get a 13-week yield of around 5.2%. So shorter-term, interestingly, bonds are providing better yields than longer-term for the super safe government bonds. But investors may prefer a dividend stock like Verizon for the potential of dividend growth and the potential of stock price increases. So there are some pros and cons versus investing in a dividend stock versus government bonds. I won't get into too much detail about that. I'll just wanted to provide some comparison between what dividend yield you can get with Verizon and what you can get from a government bond right now. So in Verizon's latest quarter, the company delivered earnings per share of $1.09 compared with earnings per share of $1.17 in the same quarter last year. Total operating revenue of $33 billion was up 0.2% from the first quarter of the prior year. And that's been a knock with Verizon is it's a relatively slow growing company or no growth company. The industries it operates in wireless and broadband are pretty much, especially wireless, are mature industries with no new customers. This is, well, I shouldn't say no new customers, but mostly everyone who wants a wireless phone already has one. And what you're getting with Verizon is trying to capitalize on the new folks entering the market, the younger folks that are now growing into having a wireless phone, and then trying to take market share. And in terms of the market share gain, Verizon is not going to win at that, or at least I don't think Verizon's going to win at that. They position themselves more as the premium provider. And so they're having a hard time. They're going to have a hard time taking market share with the higher price offering compared to, for instance, T-Mobile, which offers lower prices, which allows T-Mobile to gain some market share. Now, on the other end, Verizon does have a growth segment, and that is its broadband. In the broadband business, it's added 3.4 million subscribers, over 3 million broadband subscribers in the last 2 years, I should say. So they now have 11.1 million broadband subscribers as of the first quarter of 2024, including 3.4 million subscribers on fixed wireless. So this is one area of the business that is growing, whereas the wireless segment is flat to declining as it loses market share to rivals in the industry. So Verizon also saying that they're on track to meet their financial guidance and deliver positive consumer postpaid net additions for the year. That's great news. So I mentioned that segment is not growing or is not expected to grow, and they're losing market share or potentially losing market share. It's great news to hear that they're going to be net positive for the year in that segment. So it's not going to be large increases, but just the fact that they're net positive is good news for Verizon stock investors, as investors in Verizon stock are not expecting phenomenal growth from Verizon here. Now, total revenue of $33 billion was up just 0.2%, and the increase can be attributed to pricing actions. They've been increasing prices. I mentioned they're one of the priciest offerings in the segment, and combined with improved operating results that were offset by a decrease in wireless equipment revenue due to lower upgrade volumes. And that's been the story in the wireless network is people are holding on to their phones longer. They haven't been upgrading at the rate they were previously. And partly due to some of the less exciting incentives offered by the rivals Verizon, AT&T, and T-Mobile. I highlighted about, 6-9 months ago that Verizon and AT&T were sending signals to each other suggesting that they were not going to be offering incentives, that they were not going to be going after market share, that they were going to be going after more profitable customers and really trying to focus on the customers that they're able to serve most cost efficiently. Back and forth they went, sending signals to each other that, look, we don't want to compete against each other. I don't want to lower my price and offer incentives and try and take customers away from you, because I don't want you to try to do the same thing to me, because if you lower your price and I lower my price and then you lower your price, we're all going to be going towards the race to the bottom and it's going to be bad news for each of us. So let's kind of stay where we're at. You keep your customers, let me keep my customers, and let's work on becoming more profitable. And that's great news for investors. It's the opposite of what's happening in the EV industry. The EV industry has said, forget that. I'm going to slash my price. I'm going to offer more promotion. I'm going to increase advertising. I'm going to do whatever I can to try and take market share. And I don't really care about profit margins at this stage of the game. I want to increase my unit production. I want to increase my unit sales. And you see how bad that is for investors. So it's the opposite, right? When companies are communicating, telling each other, we don't want to compete fiercely, that's good news for investors, and the opposite is true. When they are competing fiercely, lowering prices, offering incentives, that's usually bad news for investors. So cash flow from operations totaled $7.1 billion in Q1, down from $8.3 billion in Q1 in 2023. But the good news is they also decreased capital expenditure. They're starting to wind down those investments they needed to expand their 5G network. Those are mostly behind it now. And so that's going to lead to better free cash flow. And that did. In its latest quarter, free cash flow was $2.7 billion. That was up from $2.3 billion. So an increase of $400 million in free cash flow. Verizon used some of that to pay down debt. Its total unsecured debt is still a massive $128.4 billion. But that was $3.6 billion lower from the same time last year. Now, debt has become more of an issue for Verizon and AT&T, for that matter. They both have similar amounts of massive debt. But previously, they were not concerned about it because they generate so much cash flow, they can pay that off. But now, as interest rates have increased meaningfully, I talked about the rates on government bonds. These companies, when the debt is coming due, they're more often interested in paying off the debt instead of refinancing it, because if they refinance today, that interest rate they have to pay on it is higher than usual, so they would be more interested in paying it off. So that's been a positive thing for Verizon and AT&T. It lowers their total debt, which lowers their interest expense, which leaves greater profit, which leaves greater cash flow, and they can continue on this positive virtuous cycle for a very, very long time because they have a over $125 billion debt load. So incrementally paying down this debt, lowering the interest expense, lowering the cash outflow, increasing free cash flow, which is going to leave more money to pay down even more debt, and on it can go for some time here. As long as they can continue generating this amount of free cash flow, it's going to be double the positive benefit for Verizon and AT&T. So an excellent quarter for Verizon, solid report, solid growth in free cash flow, everything a dividend stock investor would love to see. The stock price, after fluctuating wildly around the earnings report, as is usually the case, has settled down into the price range it was to enter the week. It's trading at $39.85, right about where it was on April 17th, the few days before earnings. Now, Verizon stock is trading at a forward price to earnings of 8.456, which is not too expensive when you compare it to the average stock in the S&P 500. But when you compare it to Verizon's own earnings per share growth expectations, it seems expensive because you're not getting any growth from Verizon in terms of earnings per share over the next 5 years. a little bit of an expensive valuation, relatively speaking, compared to the earnings per share growth. But if you're a dividend stock investor and you're only looking for the dividend yields, I would say the dividend is relatively safe. I would say Verizon has room to grow this dividend payment over several years because of those factors I highlighted earlier. So the dividend is relatively safe. The stock is kind of expensive. So I don't have the stock rated as a buy. You could see here, I have Verizon stock rated as a hold, and I updated that recommendation today. But just speaking about the dividend seems safe for at least the next few years and maybe even longer than that. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.